Hello, and welcome back to Legend Finance. Don't forget to hit that like button and subscribe to our channel. Today, we're addressing an interesting topic, dividend investing. While it can be appealing with its promise of a steady income, it comes with its own set of challenges. Limited portfolio diversity, unreliable yields, and potential tax inefficiency are some of these hurdles. In our upcoming content, we'll delve into these issues, providing you with insights and strategies to navigate the dividend investing landscape effectively. So stay tuned as we continue making finance simple and accessible for all, right here at Legend Finance. Keep watching, more insights are coming your way soon. The Hartford Study. Let's take a trip back in time to 1970. Well, with nearly 50 years of market data, we learned that dividends, when reinvested, accounted for 78% of the total stock market returns. If we rewind even further to 1930 through 2019, that's almost a century of data showing reinvested dividends made up around 42% of the market's profits. While lower, it's still a significant part of the market's gains. Traditionally, over the last 200 years, investments in the stock market have returned between 8 and 9%. However, it doesn't imply that all investors have achieved these returns. Longevity. Research from BlackRock Investments reveals that over the past 20 years, average returns have been just 2.1%, barely outpacing inflation. Why so low? It's due to investor behavior. When markets plunge, people panic and sell. When markets recover, they jump back in, but the growth phase has already been missed. However, being a dividend investor can offer resilience. This approach can help you tap into the often quoted 9% stock market return. How? You're not obliged to sell your shares to make a profit. Regardless of market conditions, you keep earning dividends like interest. This steady income helps resist panic selling, ensuring you don't fall victim to your own emotions. Now picture yourself as Kevin with $2 million in Tesla stocks. Timing the market. Let's imagine a hypothetical Kevin, who is a YouTuber, realizes that creating 6 videos a day isn't a long-term plan. He owns $2 million in Tesla stock, which balloons to $6 million. Kevin, being a long-term investor, doesn't sell. But things change. A market crash, a competitor, a new technology, and Tesla stock drops back to $2 million or even lower just as Kevin is ready to retire. He's lost a decade's progress. That's not an unusual story. Back in 2008, many people watched their IRAs and 401ks lose value, pushing retirement further away or off the table entirely. Kevin will be okay with his millions, but the lesson here for us is about risk and diversification. If you're out there, Kevin, consider selling a portion of your Tesla stock. Pay the taxes and invest the remainder in a dividend-yielding ETF. With a 3 to 4% yield, you're securing an annual income of $30.40 for life, which you can pass on to your family. Diversification is key, as Kevin O'Leary of Shark Tank fame often says. You got too much at stake with Tesla. And remember, peace of mind is priceless. Peace of mind. Investing in dividends is an approach that many find attractive due to its focus on steady cash flow. Consider a company like Coca-Cola. Even if they have a less than stellar quarter, we as investors don't need to be overly concerned. We'll keep receiving dividends as long as their core business is operational, which is likely as long as people are consuming their products. Even during unexpected events like the 2020 pandemic, dividends continue to flow. Let's visualize this. If a company's stock is priced at $100 with a 4% dividend yield, that means for every $100 we invest, we're earning $4 each year. Now, if the stock price drops to $50, the $4 dividend remains the same, effectively doubling the yield percentage. This extra income can be used to cover our living costs, reinvested in the same company, or diversified into others. However, it's important for us to remember that dividends are not a guarantee, which is a potential risk of being a dividend-focused investor. Despite some doubters, our paid bills and steadily growing investment accounts are testament to the potential benefits of dividend investing. Dividends are not guaranteed. In 2020, dozens of companies, including some in our portfolios like Delta and even Disney, reduced or cut their dividends. Now imagine you're a retiree depending on this dividend income to cover your expenses, and suddenly you don't receive your expected payment. It becomes challenging to meet your monthly expenses. This is a stark reminder that dividends aren't a guaranteed contract between us, the investors, and the companies we invest in. We aren't inherently owed any dividends. It's essential to keep this in mind when planning our investment strategies. We are not owed dividends. While it's true that the companies we invest in don't owe us dividends and can cut them at any moment, causing a potential drop in stock price, it's equally important to remember that capital appreciation or stock growth isn't guaranteed either. During the 2008 crash, while stock prices fell sharply, the decline in dividend income was about half of that. This demonstrates that dividend income can often be more stable and predictable than capital growth. As we receive dividends, we have the opportunity to reinvest them into more dividend stocks, potentially providing superior returns, especially in a flat market. If you're concerned about the risk of losing dividends, consider investing in a high-quality dividend ETF. Such funds automatically replace companies that cut their dividends, providing another layer of protection. However, remember that investing in dividends can limit a company's total growth and returns. It's all about balancing your investment strategy to suit your financial goals and risk tolerance. Dividends limit growth. While it's true that a company distributing dividends can signal that they've run out of growth ideas and hence are returning excess cash to shareholders, it doesn't necessarily imply a lack of growth or innovation. A company like Tesla may reinvest its profits for constant innovation and potentially faster stock price growth, unlike many traditional dividend-paying companies. However, this doesn't mean a dividend-paying company is dying or less profitable. These companies may not grow at the rapid pace of newer, innovative companies, but they often make substantial profits. They reward shareholders with a portion of these profits in the form of dividends and typically increase these dividends over time. For example, when comparing Vanguard's Standard Index Fund, VTI, with its dividend growth fund, VAG, over the last 10 years, VTI has outperformed. But this isn't always the case. Certain studies show that dividends have contributed significantly to the stock market's total returns over different periods. Remember, though, that dividends aren't free. They are subject to taxes, which could be higher than the tax on capital gains. Always consider these factors when crafting your investment strategy. The data is available for anyone who wants to dig deeper. Dividends are not for free. When a company issues dividends, it's true that the stock price often drops by an amount equal to the dividend distributed. Essentially, it's like moving money from one pocket to another. While doing this, you are subject to taxes, which might feel pointless compared to growth stocks where you don't face forced withdrawal and hence less taxation. Despite this, remember that the stock price doesn't necessarily hit rock bottom after dividends are distributed. It usually recovers within a few weeks and sometimes even rises. If you're concerned about taxation, consider investing in a Roth IRA where the income isn't taxed at all. On the other hand, if you prefer a taxable brokerage account like I do, yes, you'll pay a small premium in taxes for the dividend income. But this cost is worth the benefit of having the option to retire early and generate passive income. Plus, if you're retired and your income is lower, you might fall into a lower tax bracket. For single filers, you can make up to $39,375, and for joint filers, up to $78,750 in qualified dividend income without owing any taxes. Decreases diversification. When you focus on dividend stocks, you're mainly investing in large, established companies and missing out on potential game changers like upcoming small and mid-cap firms. These could be the next Apple, Tesla, Google, or Amazon, but we overlook them as they don't pay dividends during their growth phase. Sure, this does limit diversification, but remember, as a dividend investor, you're not prohibited from exploring small-cap stocks. You can do both. While dividend investing provides emotional security, it doesn't necessarily offer any tangible edge over other investment methods. No real benefit. Dividend investing, while offering comfort and peace of mind, is not just about the numbers, it's an emotional game too. Instead of fretting over daily stock price changes, it allows you to focus on cash flow. This approach enables you to stay in the market longer, potentially ensuring a more comfortable retirement without the stress of timing the market for selling stocks. Discussions about investing strategies like this one are privileged conversations accessible to those of us with the means and interest. If you're watching this, you're a finance enthusiast and likely to do better than most. Always remember that we all have different paths leading to the same goal, ending up with more money than we started. Thank you so much for tuning in today at Legend Finance. We truly hope that our discussion around the challenges of dividend investing has provided you with valuable insights and sparked your curiosity to delve deeper into this fascinating topic. Investing, as we always say, is a journey. It's a journey filled with learning, growth, and often surprises along the way. The more knowledge we arm ourselves with, the better we become at navigating this path. So stay connected as we continue to simplify and unravel the complexities of the financial world. If this content has helped you in any way, don't forget to give us a thumbs up and hit that subscribe button. Your support helps us reach and educate more people, creating a ripple effect of financial empowerment. Share our content with your friends and family. Let's build a financially literate community together. Knowledge is the key, and here at Legend Finance, we're committed to unlocking that door for you. This is Legend Finance, signing off until next time. Keep pushing, keep learning, and most importantly, stay legendary.